Greetings, everybody. Welcome to Liberty Call. Today is Monday, September 25th, 2023. I hope everybody out there is having a fantastical day and a good weekend. Well, unless you're an Astros fan and they played like dog poop all weekend against the lowly Royals. God, just terrible. Got swept. I mean, that's why I'm wearing my Astros gear today. I'm thinking maybe showing some support, showing some love to the Astros will get them back on the right track. I mean, at least they're on the road again. They have a much better road record. Their home record, unfortunately, is under 500, which or right at 500. So anyways, you didn't come here to listen about Astros baseball. You came here to hear about what's happening in the markets and the weekly update and all that good stuff. So let's go ahead and get started. If it is your first time watching Liberty Call, thank you very much for being here. If you would do me a favor, press the thumbs up button. Give me some likes, shares, subscribes, follows. Press that notification bell so you know when I go live. Let's go ahead and get into the numbers. Dow Jones was up 0.13%, 43 points, closed at 34,006. S&P 500 was up 0.4%, closed at 4337. NASDAQ up 0.45%, closed at 13,271. The VIX fell 1.74% today. It's currently holding at 1690. Canada was up 0.1%. Brazil was down 0.07. And Mexico was down 0.6. Over in Europe, Germany was down 0.98%. The UK was down 0.78%. France was down 0.85%. Netherlands down 0.47%. Spain down 1.22%. Italy down 0.68%. Switzerland up 0.03%, kind of the lone bright spot in Western Europe. And Portugal down 0.79%. Russian exchanges both red, MOEX down 0.12, RTSI down 0.29. And the Asian markets, the Nikkei in Japan was up 0.95%, Australia up 0.11%, New Zealand up 0.34%. In China, the Shanghai was down 0.54%, the Shenzhen component down 0.57%, China A50 down 0.67%, DJ Shanghai down 0.57%, Hang Seng down 1.97%, and the Taiwan weighted was up 0.2%. All right. So looks like domestically everything was better than last week, even though the Dow and the S&P kind of were in the red back and forth most of the day. And then here at the end of the market finished up in the green. So, all right, let's get to the market. The weekly economic update. Rising bond yields and fears of a government shutdown hammered stocks last week, with technology shares bearing the brunt of the retreat. The Dow Jones Industrial Average lost 1.89%, S&P 500 lost 2.93%, NASDAQ tumbled 3.62%, and overseas markets fell 1.77%. Stock sell-off. Investor sentiment took a decidedly negative turn last week when investors were caught off guard by the Fed signaling another potential rate hike this year, upending hopes that the Fed might finish its current rate hiking cycle. Stocks declined sharply following the FOMC announcement and continued to fall the following day as bond yields spiked. The 10-year Treasury yield hit 4.48% on Thursday, touching its highest point in more than 15 years. Stocks also reacted to news that the House of Representatives went into recess on Thursday, increasing the prospect of a government shutdown. The sell-off cooled on Friday, adding only incrementally to the week's accumulated losses. Fed signals rate hike. As expected, the Fed held interest rates steady, but surprised many investors by signaling another rate hike before the year end and suggesting that rates may need to remain high through 2024. In this post-announcement press conference, Fed Chair Powell remarked that the inflation battle would continue and upcoming economic data would inform the FOMC's future rate hike decisions. In their economic projections, 12 of 19 Fed officials expect to raise rates once more. The FOMC meets again on October 31st and November 1st, and then again in December on the 12th and 13th. The Fed also lowered their unemployment projection from their June estimate and revised their projection for annual core inflation to 3.7% in the fourth quarter, down from June's 3.9% forecast. Economic data this week. Tuesday, we have consumer confidence and new home sales. Wednesday, durable goods orders. Thursday, jobless claims and gross domestic product. And Friday, we have the personal income and outlays report. Companies reporting earnings this week. Tuesday, we have Costco. Wednesday, Micron Technology. And Thursday, Nike. All right. So some interesting stuff there. I mean, well, maybe not. It's not really that interesting to me, but maybe to you regular folks out there. All right. Market recap: Dow in late dash higher as Amazon climb helps tech shake the funk. It's always bad to have too much funk on you. All right, let me make a copy of that real quick and paste it over here. Okay. All right, let's get to my notes here. All righty. Where'd they go? They just disappeared on me. All right. On Monday, the Dow Jones Industrial Average made a late rally to finish the day with a gain, as a surge in Amazon's stock price boosted the tech sector, and energy stocks also saw an uptick, helping counteract the pressure from rising treasury yields. Amazon announced its plan to invest up to $4 billion in Anthropic, an artificial intelligence startup specializing in generative AI technology, including large language model-based chatbots like ChatGPT. This investment aims to accelerate the adoption of generative AI capabilities for Amazon Web Services customers. Analysts noted that this move should address concerns that Amazon has been lagging behind its peers in the field of generative AI. Alphabet also holds approximately 10% stake in Anthropic after a $300 million investment earlier this year. As a result of this news, Amazon stock rose, and other tech giants like Apple, Meta, and Microsoft also ended the day with gains. The energy sector saw a rise of more than 1%, contributing to the broader market's positive performance. Despite oil prices experiencing some fluctuations, investors were assessing the impact of sustained higher interest rates on both the economy and energy demand. EOG Resources, Coterra Energy, and Baker Hughes were among the prominent gainers in the energy sector. However, the yield on the U.S. 10-year Treasury note reached its highest level since 2007. Investors were closely monitoring remarks from the Federal Reserve officials and key economic reports, including data on inflation and the quarterly economic growth, set to influence the Fed's monetary policy. Moreover, concerns about a potential U.S. government shutdown were growing as Congress had not passed any spending bills needed to fund the government beyond October 1st. Boy, that'd be terrible if they shut down. I mean, think of the money we would save. While there is still time to avert a shutdown, some skepticism exists regarding the willingness to negotiate and pass a short-term spending bill to keep the government operational. I hope it collapses personally and burns to the ground. Credit rating agency Moody's noted that although the shutdown would have a negative implications for the nation's creditworthiness, the economic impact would likely be short-lived. Yeah, those rating agencies are someone I would trust. All right. And up last, we have an article from First Trust, Mr. Brian Westbury, their chief economist. This week's article is titled, "Don't Fall for the Q3 Head Fake." See what he has to say there. All right. The U.S. economy is showing signs of strength in the third quarter, with the Atlanta Fed's GDP Now model tracking a real GDP growth rate of 4.9%, potentially the fastest quarterly growth since the early stages of the COVID-19 recovery. Other models are projecting growth at around a 4% rate, still robust by historical standards. However, some caution is warranted when interpreting this strong performance. The unusual nature of the COVID era, characterized by stringent lockdowns followed by gradual reopenings, may be introducing seasonality into GDP reports. For instance, the third quarter typically sees a boost in economic activity as children return to school, but school attendance has been irregular during the pandemic. This abnormality could create a temporary appearance of a stronger economic growth. Furthermore, the economy may still be benefiting from the surge in money supply that occurred in 2020 and 2021. I doubt it personally. And the full effects of a decrease in the M2 measure of the money supply from mid-2022 through early 2023 may not have yet materialized. One significant factor influencing the third quarter's strength is increased deficit spending by the federal government. While deficits have been high, they are expected to moderate in 24 compared to 23. The deficit for fiscal year 23 is projected to be approximately 7.8% of GDP, notably higher than previous levels. This spending, combined with other factors, could be artificially boosting economic growth. One example of such artificial growth is the CHIPS Act, which encouraged private investment in chip manufacturing facilities in the U.S. While this has led to a surge in private spending on such facilities in the short term, these investments may not be sustained, potentially leading to a reversal of economic gains. In the long term, government spending is not seen as a positive driver of growth and can distort economic activity. As stimulus measures wear off, a recession appears increasingly likely. Although this potential recession is not expected to be as severe as those of 2008 or 2020, it remains a significant concern. Well, maybe not. I mean, I never tried to guess how bad it'll be. I just, I can see that there's horribleness out in the future in front of us. And at some point, we have to go through that downward cycle, which we seem to avoid back in 2020 with all the money printing. I know a lot of people say, oh, we have that recession for like a month or two, but did we really? I mean, all that money that the government printed out of nowhere seemed to make everything feel really good for a short period of time. And now we're dealing with the morphine withdrawals. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you guys have a wonderful day, and I'll talk to you next time. Adios.